Joe Rogan just landed a knockout punch to Twitter's share price after sending over 1 million users to the Twitter alternative Gettr. And he did that by creating a profile on Gettr and then publishing a post stating that just in case things get even dumber on Twitter, he's now also over at Gettr. And that news collapsed the Twitter share price by almost 9%, which really surprised me. And if you combine that with the hangover from the weaker than expected user growth in Q3, and continued uncertainty from Apple's iOS rollout, which has been weighing on the stock's share price and has dropped it almost by 50% since March 1st. My question to you is Twitter cheap enough to be a value opportunity at under $40 per share? Well, I was interested in it and I modeled out Twitter, and I'm going to give you that model absolutely free. So as a thank you, please smash that like button and subscribe if you're new. You're watching More Money. Let's get it. So I'm sure you guys heard all about this, but quickly to sum it up, Joe Rogan had a guy by the name of Dr. Robert Malone on his podcast. Robert claims to be part of a team that invented the mRNA technology used in COVID-19 vaccines. And if it's true, that's amazing. Thank you and your team and everyone else in the medical community who has worked so hard to bring the vaccines out to the public, and I really mean that. But it looks like people may not necessarily have liked his discussions about the vaccine mandates, as he was drawing similarities to the bad folks in World War II Germany. According to the Daily Mail, they said that he claims that society is hypnotized to believe in extreme pandemic measures. After that, he was banned from Twitter. And of course, for every action, there's always a reaction. And so Joe Rogan sent out a Gettr post saying that if Twitter gets any dumber, he's now on Gettr. And of course, you guys already know this, Joe Rogan has a large and loyal following. So of course, Gettr gained 1 million new subscribers, which some people are citing as part of the reason why Twitter's share price plummeted nearly 9% on the news. And I actually don't think 1 million people signing up for Gettr is actually a huge blow to Twitter. And the reason for that is that with social media companies, there is a first mover advantage that typically comes with a consumer monopoly, unless something significantly better comes along. Hence why we all moved from ICQ to MSN, and then from MSN we all moved to Facebook. Something better just kept coming along. But since Facebook came along, nothing better really came out, just different, which causes to splinter a bit with some people on different apps like Snapchat, Facebook, Instagram, and WhatsApp. And when it comes to microblogging, Twitter has just been around for so long that they have the first mover consumer monopoly, and I don't see that going anywhere. And this is just my opinion, and of course I can be wrong, but I think that the only company that can ruin Twitter's consumer monopoly is Twitter themselves if they continue with high profile bannings. And I think that's the real reason for the January decline in the share price. I think investors are realizing that in a more polarized environment, that particular risk is materializing more and more. Now, a keen eye would note that being down almost 9% in January is the least of their concerns, as this really just continues the trend of the share price being down almost 50% from its high of 77.63 as of March 1st, 2021. And it looks like that share price decline happened because they missed on their daily active user expectations with their Q3 results, and there appear to be lingering levels of uncertainty from the privacy changes with iOS, Apple's cell phone operating system. Which to me seems a little bit weird because Twitter actually reported scorching results with year-over-year revenue growth of 37%, and it looks to be unimpacted from the changes to the Apple iOS system, which seems to have hurt Snapchat a lot more, and to a lesser degree Facebook. So naturally, I think to myself, has this been overdone, and do we have a buying opportunity here? Well, guess what, guys? As I said in the intro, I made a model for you, which as usual, I'm giving to you for free. Just do me a favor and hit that like button and write something in the comments to help with the algorithm. And there's nothing that I don't appreciate in those comments. There's a spider cat that always just writes meow in the comments. I love it. Okay, let's move into the model. So from the model, you can see that Twitter is expected to have a phenomenal 2021 with revenue being up 46% year over year. And from this chart, you can see that I'm forecasting advertising revenue growth to slow to 25% in 2022 and then 17.5 in 2023, which gets us to that 7.5 billion in revenue for 2023. So why is it important that we get to that 7.5 billion in revenue for 2023? Well, because that's what management's guidance is for where they expect revenue to be in 2023. Whether they hit that or not is a different question, but for the purposes of modeling the company, I'm going to give them the benefit of the doubt. Now, when it comes to modeling out gross profit margins and R&D as a percentage of revenue, your guess is probably better than mine. So please let me know in the comments where you land here when you download the model and adjust the variables for yourself. And guys, I really love when you guys download the models and do change on the inputs and then give me your rationale as to why. I learn a lot from you guys. Now, you'll see a note in my 2022 EPS calculation saying that the analyst community is forecasting 96 cents a share. I have no idea what they're doing to get the earnings that high. I'm coming in at 56 cents per share. But this doesn't matter too much to me, as I think Twitter is more of a free cash flow valuation as opposed to an EPS valuation. So before getting into the free cash flow valuation, you can see that I'm using my forecasted EPS with a multiple of 25 times and a discount of 11.5%. And once I add in that excess capital that they do have on their balance sheet, I get to a valuation of $22.52 per share, suggesting that the company is overvalued. But once again, I don't really trust the EPS valuation here, as I'm for sure missing something since I'm so far off of what the analysts are looking for. So let's take a look at that great equalizer, the free cash flow valuation. Now, the first thing that you'll see from my free cash flow valuation is that I have a note there that Twitter does like to quote EBITDA, but I just don't like to use companies using an EV to EBITDA multiple, nor do I like the revenue multiple valuation methodology, which is a rant for another day. But from here, you can see that using free cash flow to value the company with a 20 times multiple, I'm forecasting the business to be worth approximately $53 per share, which means that the current share price of $40 per share reflects 75% of the valuation. There's a lot more that I have to learn about Twitter, but it seems like this is a company that's continuing to grow and does completely dominate the microblogging space. They are starting to use some of that excess cash to buy back stock, which is a great sign. Due to my complete ignorance of this space and just fear of social media companies in general, I would probably become more interested in this name with a 50% margin of safety or something under $20 per share. I actually don't think I'll ever get that, but I'm really holding out to see if I can. Download the model and change the inputs as you see fit, and let me know what you think it's worth. Also, if you haven't done so already, please consider subscribing to the channel. I do my absolute best to bring you non-hype research-focused content, and with your subscription, YouTube extends the reach of this channel, which allows us to help more and more people. And Twitter isn't the only social media company that I've covered on this channel. Facebook is one that I really do like and explain as part of my 2022 themes to look out for, which is a very important video that you can get to right here.